Thank you, Mr. Chairman. Thank you all for being here. I want to focus on another part about SIFIs. Last week, the new vice chair of the Fed, Stanley Fischer, spoke about the Fed's role in financial reform, and he made some claims about the too big to fail problem that I'd like to be able to get your comments on, and I'm just going to kind of break it apart into the different claims he made. His first claim was that the evidence was basically mixed on whether bigger banks take on more risk than their smaller counterparts. And I find that hard to believe, particularly for banks in the United States. Professor DeYoung, you've noted that 4 out of 10 of the biggest U.S. banks in 2008 either failed or had to be bailed out. That's a 40% failure rate. By contrast, only 6% of smaller banks failed during the crisis. So, Dr. DeYoung, given those data, is it fair to conclude that bigger banks, say those over $500 billion in assets, tend to take on more risk than their community bank and regional bank counterparts?
Well, thank you for reading my research, or thank you to your staff for reading my research. I appreciate that. I think it's unquestionably true that on average, larger banks are involved in riskier activities, and in the end, at least through the most recent distress we've gone through, ended up failing in larger proportions. And I think you'd have to be blind to conclude otherwise.
Okay,
I think now,
so
however, but that's point one. Point two though is, have we done things to? Is it size alone that's causing these banks to take more risk?
We're going to come there.
Yes,
we're going to come there. I promise.
All right, very good.
Okay, because we're just going to do these though by pieces, because I want to make
Very
sure
good.
I'm getting
I'm going to hold you on that.
All right.
Okay.
And that is, the second one is about the question about economies of scale for big financial institutions. Vice Chair Fischer addressed the economies of scale, saying whether or not banks become more efficient and reduce their marginal costs as they grow bigger. And he pointed to recent studies that say that such economies of scale exist even for the largest banks. So I'm a little skeptical on the point, but I want to open it up to the panel. Does J.P. Morgan, for example, really become more efficient when it grows from 2.4 trillion to 2.5 trillion? Or we'll do an even bigger leap when it grows from 1.5 trillion to 2.5 trillion. And I'll just go down the list here. Dr. Herring?
I think that is a very difficult issue. All the evidence until very, very recently has indicated that economies of scale peter out at a level well below the $250 billion mark. And in fact, if you look at banks of any given scale, the difference in efficiency between the most efficient bank and the least efficient bank is much, much greater than anything you could get out of scale and scope. There has been some very recent research actually done by the new president of the Cleveland Fed that suggests otherwise. What concerns me about this is that I do not feel comfortable that it's taken into account the too big to fail advantages, nor do I think that it has taken into account the obvious diseconomies of management. It's very, very difficult to manage one of these institutions. It's humanly impossible to understand everything that's going on. And I think there is a limit to our ability to actually exercise effective control over such huge, complicated institutions that really needs to be taken seriously.
Okay, good. Dr. Thomson, did you want to add anything to that?
Yeah, I think, along with the funding advantages that these institutions enjoy, because obviously you don't have to pay as much for liabilities if people credibly believe that you'll never be closed and losses imposed on them. But there's also sorts of other activities within the large institutions that gives them an advantage over other institutions from this massive size. And I think these all get rolled into these studies that are being picked up as an efficiency, which really is an artificial efficiency. If you look at some of the things like lines of credit, standby letters of credit, and all these sorts of things, customers take those from banks they think who can perform on them. If you're a bank that's considered too big to fail, you're considered somebody who's a good credit who will be able to perform on that contract going forward. And I think that aspect of it is also missed in why we would pick this up from the large institutions. But no, I don't see don't believe in the credibility of the economies of scale literature that go above the $250 billion mark.
Anything you want to add to that, Dr. DeYoung, on the efficiency point. I
Yeah, on the
promise we're
efficiency
coming
part.
to the third
On the efficiency
point.
part, yeah. Scale economies, we don't have any idea whether the scale economies of large banks. I publish. I'm the editor of the Journal of Money, Credit, and Banking. Two of the most recent three important scale economy studies have been published in my journal. The most recent, and all three of these important studies find different results. All right. So we don't know. No disparagements towards the researchers. These are incredibly different things to be trying to estimate. I will point out that the most recent of the three papers attempts to adjust for the financial advantages that too big to fail banks have. Puts, as James has mentioned, puts those into the cost function that they're estimating. And when they control for the too big to fail advantage, the scale economies go away. So this is one out of three studies. We can't draw any firm conclusions on this, but it does suggest that, and this is to the point earlier, that large banks are more risky. However, they have lower costs of financing due to too big to fail, and this gives them a different set of profitable opportunities to chase.
So I tell you what, instead of asking the same question a fourth time, what I'll do is I'll now cut to the one that intersects the pieces, and that is, so we have the problem of the increased riskiness of the largest financial institutions. No evidence that they are more efficient, some evidence that what they're doing is taking advantage of the benefits of too big to fail. I want to hit the very last part of this, and that is the intersection of size with risk, with cost. And that is, if two banks have an equal chance of failure, let's set it up that way, is there anyone who thinks that the failure of a $2.5 trillion bank poses a smaller risk to the economy than the failure of a bank that is half that size or a quarter that size? I want to see the intersection here. Why don't I start with you, Dr. Kupiec, and we'll come back down the other direction.
No, I clearly think that size does create bigger spillover effects. And at the very largest institutions, it would be a bad thing if one of those institutions fails. I think there's no doubt about that. Even under the best Title II Dodd-Frank thing we could come up with, it still wouldn't be pretty. But where this kicks in the size range is, I think, a pretty difficult question to know. So if $250 billion bank is 10 times smaller and not doing the same activities as a J.P. Morgan Chase, a $100 billion bank is not doing anything like that probably. So I mean, there's a big range here, and I think for sure the risk of systemic risk is related to size. I've published papers that show that using historical data from 1900s before we had any safety nets. It's pretty clear that you have a lot of little banks fail, you got a problem. You have one big bank failing, you got a problem. If the little banks fail at the same time, but where this line crosses, I can't pick a number.
Okay, can't pick a number, but we're sure that the end is somehow different here, the furthest point out on it.
I would agree with that.
Dr. DeYoung?
Yes, I agree with Paul. There's no way we can draw a bright line. I will point out that some of these large banks who are using the same business models as the large banks that became insolvent came through the crisis with flying colors. In fact, some of them came through so well that we asked them to buy some of the large failed banks. I wouldn't draw any lessons and apply them to all banks. The best of all cases is we remove the too big to fail subsidies and then let the market determine which bankers are good, smart bankers and which bankers aren't.
Dr. Thomson?
So, yeah, I'm in agreement with my two colleagues. An element of this is not only will the larger institution have a much bigger impact because it's just going to affect so many more markets and so many more activities, but there's also the aspect of anticipation. We can imagine a $250 billion bank being taken down and failed. We can't imagine a $2.4 trillion. And the expectations of what's going to happen and how that will be handled, if it's handled differently, as we saw with Lehman Brothers, that's going to create the dislocation.
Good point. Yeah, Dr. Herring?
I agree with all three of the panelists. Let me make one additional point about economies of scale, and that is that there are elements that clearly do have economies of scale. If technology is involved, we know that running larger batches of things is going to give you lower costs. And what we need to figure out is a way for the whole industry to participate in those economies of scale rather than concentrating them in a single institution and tying up a systemically important function with the fate of one institution. The other issue that's giving rise to economies of scale that's very worrisome about the current regulatory system is that the fixed costs of running a bank, having the systems in place, having the compliance officers in place, is becoming a very large barrier to entry, and it's something that actually will make it more efficient to be larger.
Yeah. And again, talking about where we are on that continuum, but it's a very good point, Dr. Ehring, so thank you. I appreciate it. I think we have agreement that size matters, that it wouldn't be smart just to limit the size of banks and sit back and say we've solved every problem, but that the combination of adding risk, of banks that are more complex, that there is a greater impact if they do fail, and I would add that they have more political power and that permits them to pull in additional subsidies, all matter. And that happens because they get big. So we can't win the battle against too big to fail just by attempting to make banks safer. I think the battle for a safer banking system is also a battle over size. Thank you. Thank you, Mr. Chairman.